Dear clients, welcome to Phillip Capital's Weekly Market Watch. My name is Nicholas, investment analyst from Phillip Securities Research. This week, we will be talking about the offshore and marine sector. Let us first take a look at rig builders under our coverage. Keppel Corp's results were mostly in line. Earnings were down year-on-year, mainly due to a drop in revenue recognition from sales of reflections at Keppel Bay and lower volume of work in its O&M segment. Sembcorp Marine's results were slightly below expectations due to conservative recognition for new design rigs and lower revenue recognition. Keppel Corp's O&M margin remains solid at 14.2% in 2Q13 versus 14.1% in 1Q13, while Sembcorp Marine's operating margin eased slightly from 13.7% in 1Q13 to 13% in 2Q13, supported by the gain from disposal of PPE of $13.7 million. We believe Sembcorp Marine's margins will continue to be under pressure going forward as it starts recognition for the second Brazilian drillship and new design well intervention semi-sub rigs, which will yield lower initial margins. Although the fundamentals for the O&M outlook remains strong, management from both Keppel Corp and Sembcorp Marine see competition from the Chinese yards and Korean yards is beginning to intensify and may put pressure on margins. That said, we think that downside risk to Singapore yards are limited in the near term due to better pricing secured. Indeed, Singapore yards have managed to raise pricing by about 14 to 21% for their proprietary designs since early 2011, even though the Chinese peers have aggressively entered the offshore market with lower pricing and attractive payment terms. In addition to the resilient prices, we believe Singapore yards can continue to benefit from some productivity gains from executing on numerous repeated designs over the past few years. This in turn should support margins. Over at that small mid-cap space under our coverage, Ezion reported solid quarterly results driven by new projects contribution and steady margin. Its gross margin remains steady at 46.3% in 2Q13 versus 45.9% in 2Q12. This is also slightly higher than 1Q13's 44.9%. We continue to like Ezion for its good business model and high earnings visibility via its SEU fleet expansion with firm contracts already secured. In contrast, Ezra's reported a disappointed set of results, no thanks to its subsea segment due to delays in project execution and additional unexpected cost recognition for certain projects. This leads to a sharp drop in gross margin from 16.7% in 3Q12 to 0.7% in 3Q13. We expect downward pressure on Ezra's margins for the next few quarters, as it may still take some time for its subsea segment to fully integrate the AMC business. Keppel Corp remains our top pick within the offshore and marine sector. Allow me to run through with you 4 main reasons why we should invest in Keppel Corp. First, its global yard network. Industry consultant Wood Mackenzie sees deepwater drilling activity and spending rising significantly over the next decade from $43 billion in 2012 to $114 billion in 2022. This, in turn, will require 95 additional deepwater rigs to be constructed between 2016 and 2022, representing investments worth about $65 billion. Keppel, with its near customer near market strategy, has a global network of over 20 yards, which allows it to be in constant close contact with customers and their markets. We believe this will allow Keppel to benefit from the growing deepwater capex spending over the next decade. Second, resilient O&M margin. We note that average prices for its proprietary KFL B-class jackup design have been on a general uptrend since bottoming in 2010-2011. In specific, prices have increased by more than 10% from trough levels of $180 million to current pricing of around $205 to $210 million. Furthermore, Keppel's product mix, which was previously rather mixed, also sees jackup rigs becoming a stronger contributor to its order book year to date. This will be positive to margins going forward due to higher productivity and efficiency from the construction of similar rig design, since the majority of our 2014-2015 revenue will be materialized from contracts secured at higher pricing in 2012-2013. We believe Keppel's O&M margins should remain robust in 2014 to 2015. Third, good dividend yield. Historically, Keppel has a payout ratio of around 40 to 60%. We believe its stable earnings and steady free cash flow should help dividend yield to remain strong at about 4 to 5%. We are assuming a payout ratio of 50% in our forecasted years, and currently it has an attractive dividend yield of 4.6%. Fourth, new product offerings. On the last quarterly briefing, management said that they are showcasing a new drillship design to oil majors and operators as an alternative to the Korean yachts design. Feedback from operators has been positive, and Keppel is confident it can offer a compelling alternative to current ones in the market. Given the increasing competition in other segments, we think it's a prudent strategy. As for the FLNG FEED study for Golar, which is announced in November last year, it is expected to complete in 3Q13. This is Keppel's first FLNG related contract and represents a potential growth segment for Keppel as well, as there are currently no FLNG in commercial operation at present. We believe penetrating into new product areas like drillship and FLNG can be a strong re-rating catalyst for Keppel. Do note that Keppel is currently trading slightly above its historical average long-term PE of 10.7 times. That's all we have today. Do stay tuned to next week's video. Thank you.